Righto, buddy boys, we're going to bloody North America. Canada.
We got 2 deals in North America today.
Oh, yeah. Go the maple syrup today. We're on fire.
That's it.
I had pancakes on the weekend too. It was
I
a
did too.
sign.
Did you? There you go.
Oh, there we go. All right, so big deal coming out of bloody Newmont divesting one of their non-core assets to a company I've never heard of, but we'll know shitloads about them today after today.
Orla Mining.
Orla.
They've got a bit of a brand reputation out in North America. They've got a bit of a management premium associated with it, Matty.
They're obviously not big enough to buy all Newmont's non-core assets. They've just bought one of them. And we've got Spartan met results. Why not go into a bit of metallurgy and Sayona Piedmont.
That's it.
Walking down the aisle. Take it away, boys.
We'll start with Orla. Like you said, Matty, scooping up an asset, Musselwhite from Newmont. So up in North America, headline was up to an $850 million US dollar deal, 810 rather, being up front with 40 contingent. So everyone knows Newmont, but why not share a bit of colour on Orla? I think to our North American audience, like you say, Trav, might be quite familiar, but down under, they're a bit of an unknown entity. So they've got a producing asset, the Camino Rojo mine in Mexico, and a development asset in the States. Currently just producing about 135 ounces per annum. Market cap 1.9 billion, actually bounced a bit on this deal, so the market kind of liked it. And like you say again, Trav, supported by the market, bit of a premium. In terms of shareholders, PLL about 10% of the company, personally. Then you got Fairfax, not the Aussie Media Group.
Thank you for answering my question I was about to ask.
You also got Newmont as big shareholders and Agnico. And then there's, they're all pretty chunky shareholders, and then there's a sort of trailing list of single-digit percentage.
That's an attractive list of shareholders to have, which you imagine kind of gives them a bit of firepower when it comes to wanting to do a deal. Not that they raised equity here, but yeah, nonetheless.
Definitely, mate. And the last fun fact about Orla is that their non-exec chair, Chuck Jeans, he ran Goldcorp from 2009 to 2016, so he would be quite familiar. That's a period in which Goldcorp was the owners of the Musselwhite mine.
So tell us about the Musselwhite mine. What are the metrics?
The metrics. So Canadian underground gold mine, 6.23 grams per tonne reserve grade. The acquisition is based upon a reserve life that runs out to 2030. They're talking about an all-in sustaining cost of a bit under US $1,300. So $1,270 is the price they sort of quote there. 200,000 ounces per annum. In terms of the processing plant, Matty, 1.5 million tonnes per annum, although it currently only runs at 1 million tonnes per annum, and decent recoveries, not unexpected given the high grade we're talking about. 96% historically is what they talk up. It's also a FIFO operated mine, which is interesting in light of comments you've made previously with regards to mining towns having sort of somewhat different cultures about how long they want the mine to, operate for, and these sorts of things. So it kind of stands out culturally as quite a positive type operation where you're not maybe entrenched with unions and other type of things like that.
So is it FIFO as in expats, or is it FIFO for Canada and America?
Canada, yeah.
Canada and US.
Yeah, I'd imagine the majority just fly from other Canadian cities.
Yeah, I did. I was watching one of the videos regarding the FIFO and the camp aspect. I'll show you.
We're in the process of doing a camp upgrade right now.
Sounds like that camp upgrade needs to be a bloody grounded camp upgrade, boys.
That's the only way to go.
Absolute no-brainer.
Mate, if you've got an old shithouse camp, like I don't know if Musselwhite have got, mate, if grounded do the upgrade, it's then considered a grounded camp. One of the best camps beyond a Newmont standard.
You can't acquire an asset from a major like Newmont and then not give it a tier 1 camp.
No, mate, you got to put a bit of love into it. You got to put a bit of a Sicilian feel into the camp. And look, Paul Natoli, if you're listening, mate, I've done a bit of digging for you in terms of Ontario builder recruitment. If you do get this gig,
what did you find out?
As of 2021 Canadian census, approximately 905,000 individuals in Ontario reported Italian ancestry. So about 6.5% of the population. And then of that, there is estimated 10% of them are from the southern regions of Italy. notably Sicily. So there is potentially 90,000 Sicilians in Ontario right now that Grounded Construction Group could pick from to help build this camp. So anyone in Ontario that's just finished their building apprenticeship, give Paul Natoli an email. He's in the show notes. He'll give you a gig straight away.
Grounded to going international.
Grounded straight to Ontario.
Get on board.
Oh, can't wait. Right. So what about the ore body, JD?
So the ore is mined from a couple main sources. The ore, the mine rather, it's pretty old now, 28 years. So it's been going a while, obviously getting a bit deeper and deeper. Like a lot of these in Canada, sits under a lake. Uses a conveyor to get the ore to surface, which is the cause of a fire in 2019. That sort of happened early 2019, which was the same year that Newmont took over Goldcorp. That was a sort of $10 billion scrip deal. So came into the fold with Newmont, but the mine was out of action for about a year, and then it was actually disrupted quite a bit in 2020 due to COVID restrictions as well. So the company talks up that they used that time to work on other improvements, improve the infrastructure at the site, but was out of action for a little while there. But 6 million ounces been mined here over its history. 1.5 million ounces are in reserve, so they've got a bit to work with.
It's funny when you talk about the reserves, and you look at this one. Like, it's actually not that deep. Looking at, they'll bring up the cross section, the long section of the ore body. Like, it's what friggin'
not steeply dipping at all.
What is a bit about 1,300, I think. No, sorry, it's not it's only mined down to about 1,000. But you look at that plunge. That's what we refer to as the plunge. Like, it's freaking flat. Like, if you put it, compare it to, I'll show you the picture of Tanami. Like, Tanami plunges at about 45 degrees. This one plunges at like 30. So it presents a massive challenge for determining your reserves, because what happens is, when your decline gets down to a certain point and the ore body's plunging away from you, I'm trying to keep my hands close so the camera remains focused, so it's not going in and out. When it plunges away, you can't just fucking drill over there and get a good angle on the ore body to properly define it. They're long and they're intersecting at a freaking shitty angle.
It's part of the reason it's always had a sort of 7-year reserve
which
life.
6-7 years, and that's probably a function of, because it's plunging so much. Like the gold ore per vertical meter is a lot higher, like, because it's like your body's going that way instead of that way. So what you've got to do with these cases to prove up your reserves is, like, pretty much put these massive fucking exploration drives out away from where you are, to then get over the top of the ore body down there and get a better angle. But it's a lot of development. Those exploration drives, especially once you get to a kilometre deep and you got the geothermal side of things and the auto compression. So it's getting hot there, a single head, and it's it's a lot of unnecessary capital to explore. But then you can kill two birds with one stone, in terms of, like, another challenge with these plunging ore bodies is the ventilation. So, and they do mention it in one of the calls, is like maintaining the ventilation at depth, because one, it's under a lake, so you can't just punch a raise bore up through the surface for your return airway system, because there is water, and so you've got to keep linking your return airway up. But as the mine gets deeper, so you go down a level, so you're over here, and the bottom of your return airway's over here, you've then got to drive back that way to link that return airway up. So it's a lot of ventilation drive development. But I'm not sure if they do this, but what they could do is that with those big long exploration drives you use, you could then, once you've finished exploring and then you go down to the bottom, then below it, then you could punch a raise bore up and use that exploration drive as your return airway later on. Yeah. So, like, there is options to do that, but it's just a lot different to a dead vertical. I remember at Wahroonga, Agnew, which was Goldfields. Like, it is fucking vertical. Like it is that going down that decline, it is just a spiral, and you'd be driving down there and just like for fucking hundreds and kilometers. It just a dead vertical spiral. Oh god, it would have been a pain. You imagine being on the decline, Jumbo. You'd be like, can I just get a fucking straight cut? Would be nice. Oh, it'd be you'd get good at doing turns. So I think ventilation, keep maintaining that ventilation. I think they said with the conveyor, it sounds like it was a crusher. So there was a hoist. There's a winds. They call it a winds, but that's a hoist.
Yeah.
So it sounds like there's a crusher with a shaft at some point that goes up from the bottom levels, hoists it up to where then the conveyor starts. So I think the conveyor is like a fixed starting point. They crush it
Underground.
further down up to the conveyor, which it might be halfway up the mine or something.
I think I saw that in Old Prezzo.
And then it goes up the conveyor. So I think it sounds like they did a lot of work to. So then once they go below that, they would then truck up to the crusher, crush it, hoist it up to the conveyor. At least they're not trucking it out friggin' from shitloads underground.
Yeah.
And because, let me get this right. Nah, even though it's plunging, it'd be still the same vertical distance up 1 in 7, even if it's plunging, it's just a different direction. So yes, it's just the joys of a shallow. But as I said, shallow plunging ore bodies, you don't have to do as much vertical development to get as much level development done because it looks like there's over 1 kilometre or so of or more of strike of ore there. So you get a shitload more level development done. You don't have to go as deep as quick, but it's very hard to define your ore body. I'd say they are assuming that it's just going to keep fucking going that way. Mm-hmm. I think Olympic Dam's the same. I think it's like, they reckon it's like a big friggin' shape of a saucepan. It's just this handle and then this big thing, and it's just flat and just goes for freaking ever.
I think you're dead right. I think they've poked in a couple holes that sort of show strike could continue 3 kilometres, but again, it's a sort of cost thing of proving that out, and they'll do that in time, won't they?
Yeah, so don't get too deterred by reserves with these gold ore bodies, especially a bloody shallow plunging one.
I think that'll tie in perfectly with a bit of valuation chat later on, and what the management team is kind of thinking with a 6-year reserve and how they kind of think about that.
Another thing, I watched a snippet from a presentation. It was done last year, and it was about Musselwhite from obviously when Newmont owned it before today. It's just, I'll play the whole snippet, and it's just something you can see how different underground mining methods, culture, advancements are in North America to what we know in Australia. I'll play it all for you.
Let's do it.
So some of those improvements, we implemented jumbo bolting at Musselwhite. That's been a big transition for us. We're in the process right now, but we're getting rid of the McLean bolters, and we're using one tool, the jumbo, to allow us to drill and bolt and advance the mine. That's unlocking a lot of potential for us, and it eliminates pieces of equipment going in and out of the headings. We moved our blasting. We moved blasting to shift change. So we were doing a lot of blasting on shift, not very efficient. So we moved that to shift change. We're much more efficient and safer in our blasting processes. We're not having to move people in and out of the operation. And then we implemented early mine entry. We were losing probably 2.5 hours at every shift change. And so we implemented longer shifts, but we implemented early mine entry so we could get the mine ventilated out faster and get people to the working phase quicker. On the production side, we implemented tele-remote mucking. So no longer are we using line of sight mucking to extract ore out of the stopes. We're using tele-remote, and we're looking to advance that to potentially some automation.
Now, remember, this is the world's biggest gold miner, Newmont, and this was from the stuff they were doing from 2019 onwards. So they only just started bolting and meshing with the twin boob jumbo. They were using the McLean bolt rigs. I think they said McLean, and I would assume then a twin boom jumbo to separately bore with. So that's obviously never how it's been done in Australia. Like, it's always just been bolting and meshing with a twin boom jumbo, and then they'd bore, and you're just getting more out of the one machine. So they've only just started sort of transitioning that in the past few years. Sounds like they were mid-shift blasting, which for the development. So it's and for if that's happening, and remember, you've got a deep spread out mine, so it takes ages for people to get to work. So they'd probably knock off, go to like a crib room, they'd blast, everyone would have a feed, play cards and fuck around mid-shift while they blast, wait for re-entries to complete, then go back to work, and then probably a few hours later, knock off, go to the surface, do a handover on the surface, get the other shift down, then they'd mid-shift blast, and there's just a lot of time doing nothing.
Lost, yeah.
So they've finally got it to the stage where it sounds like they're end of shift blasting, working through the whole shift, and effectively probably doubling the time down the hole. Because the only reason you would mid-shift blast for development is if you have absolutely minimal headings in a mine and you've got one jumbo you just need to fire those headings straight away so you can get bogging, so you can keep the development cycle going. And you need to have sometimes they do it in production mines when you're trying to push an area down the bottom and you have an independent firing zone. So you'll have, say your production's up here, then you go down the decline, there'll be a tag board. And so to be down in that bottom of the mine where all the development's going on, you tag on, there's a second tag you put on. You boys remember tagging on.
Yeah, mate.
So you'd have 2 tags, you tag onto that, and then if they want to fire that, everyone has to tag off so they can still be mining the stopes and everything up here, but then you can independently fire down there. So you're decoupled. But they're like, mid-shift blasting is what you do on portal jobs. So like at Spartan, for instance, they're punching those the exploration declines at the moment. As soon as they'd finish charging one, they're like, well, we can wait till end of shift, or we go fire it right now, start bogging, and that's when mid-shift. So the fact you'd never do it in a big mine unless you've got it fully unless you've got no headings. I would imagine a mine this big, you should have a lot of headings.
Yeah.
Because otherwise the mine just has to stop work. So
it's these productivity kind of losses relative to the Australian mining way, which was like the appeal for like the Northern Stars and the Evolutions to acquire assets over there, thinking they could just easily kind of replicate the methods in Australia over there, right?
Yeah.
But it just proved harder.
Easy to replicate the methods, but to go and tell mining culture that, oh, we're doing it this way now. We know you've been doing it this way for 30 years. You're wrong. We're right. That takes years and years to transition that and delicately to get them to come on board with that method that they think is, oh, fuck that, we do it this way.
And unions you're dealing with in places as well.
Yeah. And so it's not when you're on the other side of the fence, it's like it's very hard to acknowledge that, oh shit, we are wrong. You guys are heaps better at this than us. It just doesn't work that way. So it takes years and years and years to change that culture. Another one was like that, because I was talking about they were losing 2.5 hours every shift change. So I assume they were firing at end of shift 2, probably the production stuff. And it says they started early mine entry. So it sounds like they weren't even getting like the re-entry crews to go down. Like usually you fire, then you'll go down half an hour after that and start checking all the gas levels, and as soon as the gas levels are below the acceptable limits for the, I think it's CO, I think it was. Jeez, I forgot my gases. Carbon monoxide, I think. Then you open that area, then you go deeper, make sure, and you gradually do it. So like 2.5 hours plus the mid-shift blasting. Like it sounds like it wasn't much. The productivity was very low, and sounds like they only recently introduced tele-remote bogging. So they were using line of sight bogger like before that. So line of sight's effectively you're looking at the bogger from a distance on the drive, sitting on like a turkey's nest, and you've got a little hidey hole you can get into with a remote control, watching it, listening to it, and then bogging it visually from could be bloody a long way away. So it's a fine art for people that do it, but that. I don't even know if that's even done in Australia anymore, because there's been fatal incidents where people have been squashed by boggers because they were like there and might have been standing somewhere they didn't. Bogger might have got out of control or malfunction. I'm not sure, but there has been. So I don't even think it happens in Australia anymore, line of sight bogging. May on small operations, I'm not sure. So, and the tele-remote, because tele-remote bogging's where you're in a hut either underground or on the surface, watching a bloody TV screen, and you essentially got a little bogger simulator there and operating it from there. And the technology with that now is like, I'll show the video here of the that's the Sandvik Auto Mine. That's one of the systems. Like, you can map the path of the bogger, so like they pretty much get the bucket, turn it, flick a button, and it automatically goes back to the stockpile based on the map that you've shown. So it doesn't hit the wall, just flies along in second gear. And the operator just has to get the bucket and tip the bucket. I think you can even auto do that now. And then they can operate multiple boggers in using one operator.
Yep.
Like, they can have and then you can operate over shift change, because when you're firing, you can keep the remote boggers going.
Yeah.
So all that technology's been pretty common over here, but it sounds like it's just even at a Newmont mine in North America. It's only just started really coming in. So it just shows how different the mining cultures are underground from here and over there. So
there is some.
Don't mean to sound like a dick, but just highlighting the obvious.
room for improvement everywhere, right? And that'll, in the long run, make them a bit more money if they can sort of capitalize on those things. Hey.
Yeah, just do it our way. It's quicker.
So let's talk about how they are paying for the deal. So a pretty interesting financing. Trev, we sort of dug into this one. So like I said, US 810 upfront plus 20 million each if gold averages over 2,900 over the first year afterwards, and over $3,000 an ounce over that second year after closing, so up to 850. But we'll now flash the sources of cash, so how they're going to fund the transaction. First up is 350 million, all US I'm talking about here, a 3-year term gold prepayment. So essentially every month they will deliver gold to the facilitators of this gold prepayment, i.e. you're paying your principal down in gold, not cash. They call it roughly 150,000 ounces or to go down, and it's based upon the prevailing gold forward curve at the date. So imagine this is locked in when the transaction is agreed, needs to be voted upon. They want to execute this by Q1 of next calendar year, that is. So the prevailing forward price, it will, it's always sort of where the gold price is now and then goes up a couple $100. Right now it sort of approaches kind of steadily $3,000-ish come 3 years' time. So they call that about 16% of their annual production over the next 3 years. You've then got a con note that makes up $200 million of the financing. That is convertible at Canadian $7.90. Their stock closed after that bump on the announcement at $6. This has a 5-year term, 4.5%, plus a bit of an attaching warrant. You've also then got a revolver for $150 million and a term loan for $100 million, both actually paying, relatively little compared to some of the other smaller, riskier mining companies we've seen. They're paying SOFR plus a margin, which is about 3% depending on the leverage ratio at the time.
I actually quite like how they finance the deal. There's no equity dilution here. Okay, maybe the convert in an upside scenario, but
yeah,
like for all intents and purposes, no upfront equity dilution. That's positive. So if we assume they're kind of paying fair value for the asset, right? Look at the instrument doing the bulk of the heavy lifting and the financing. It's that gold prepay where they're going to be locking in an implied kind of gold price for future deliveries based on the forward curve at that time. Like you say, JD, the forward curve is sort of it's sitting above spot. It's well above consensus, and they're effectively locking in those prices with this instrument for the quantity of gold to be delivered into that prepay. And I like that because none of the gold mining equities, all are included here. The market's not paying spot gold price for them. They're paying kind of consensus gold price, or maybe a little bit above that, but
just a bit over 2,000.
Yeah,
ish.
They're not. The equities aren't reflecting spot gold. They're reflecting a curve which trends sort of lower over time from a gold price perspective. But the financing arrangement here gets to lock in closer to
higher prices.
Spot future forward curve. So they get the benefit of locking in high prices, despite the fact that the market's not paying that for the equities. So I quite like it. I'll play this snip to elaborate a bit from the M&A call.
NPV on reserves only is $760 million at $2,150 per ounce gold. and almost $1 billion at $2,500 per ounce gold.
So if you take their word for it, they're paying $850 million, including the contingents, which is probably about 0.8 times NAV on their own kind of reserves only scenario at spot gold price of US 2,600-ish today. The prepay, they get to lock in some of the value upside from paying less than spot NAV, and they also get the benefit from ounces not in reserves, like you talk about, Matty, if it just kind of keeps on continuing, which you sort of expect the ore body to do.
Fucking hope so.
We should probably chuck in, there is financing costs. It's not purely...
By all accounts, the prepay looks expensive, like from the financing cost perspective. It's just the utilisation of the instrument I quite like, given what gold price has done in a short period of time and what it kind of... you're always apprehensive in doing pro-cyclical M&A. I think by kind of, locking in the forward price via the prepay instrument, they're protecting themselves from looking silly doing pro-cyclical M&A and not issuing a bunch of equity too.
So the gold prices sort of run, you think about what you can kind of utilize. The first thing you kind of think about is your equity, if that's also run on the back of a gold price run. But this is a bit of a creative way to tap into that without diluting.
Yeah.
We'll have to see. What do you think about, is it is it good bang for buck? What sort of valuation they putting on it?
So it depends what you flash through. Like Trav said, 0.8 times NAV if you use 2,600. If you use, which is the prices they chuck down the model, $2,150 US, you're paying a bit over 1 times NAV. So you're paying pretty full value, although the upside is that is only on reserves and that is on a gold price $500-ish lower than where we are today. So if you're confident that, and I'm sure the management team is confident that this mine is not going to stop in 2030, it's going to keep going for a good while longer. And you're also, why would you be managing a gold company if you're not thinking the gold price is going to tick along? Then if those things hold, and importantly, if that gold price holds true over the next few years, importantly, as it sort of ties in with your financing, then you will see a bit of value. And then cream on top of that is all the other flows of being one of a standout bunch of names in your jurisdiction and all those other things that you get.
Yeah. Jumping ahead a bit, Matty, this is to that exact question. I asked a North American correspondent what he thought, and he told me these points. Definitely very full price at 1.1 times NPV at a 5% discount rate at $2,150 per ounce. Is that the right number to use? I don't know. But he reckons that was expected because Newmont apparently had over 100 CAs signed for this sale process. So it was, an attractive sale process.
Yeah.
Orla is a mid-cap darling here, given how well they delivered low-cost Camino Rojo, an asset they picked up for peanuts from Goldcorp. He reckons the Orla guys will likely push for the, mine life out from 6 years to 10 years in the next year or so. And he reckons, full price paid, but if they can manage the grade decline and the sustaining capex, he reckons, they'll do well out of it.
The grade decline's an interesting one because I looked back 20 years to see what the reserve was back then, and the grade was a bit lower. It was 5.5-ish grams per tonne. Very, very hard to find what the cutoff grade being used, but today, like I said before, 6.2 roughly grams per tonne using a 3.8 grams per tonne cutoff grade. Going deeper and all that, but that has over 28 years remained pretty consistent.
96% recovery.
Yeah.
I think if you look at my bush maths and looking at it, you look at it looks like Newmont's put a bit of capital in it with the crushing, hoisting, conveyor system. So it looks like, and the 1.5 million tonne plant, existing infrastructure, 200,000 ounce mine, potentially a bit over $2,000 Aussie, all in sustaining, and they've paid what? If we convert it to Aussie to try and compare it to Aussie things, paying what, 1.3 billion, not all up front, effectively. It's like you compare that to a Spartan that's going to probably need to be taken out for 2 billion.
It's
bush
crazy.
maths.
Yeah.
Yeah, it doesn't look too bad.
No, but it does look full value when you compare it to like the Telfer Havieron deal, for example. But the difference is obviously the dynamics of that sale process, which gave heaps of leverage to Greatland Gold. It looks full valued versus that, right?
So they talk about $150 million free cash flow per annum at a 2,150 gold price, everything remaining constant. And, you've got other potential, they talk a lot about optimizing all those sorts of things. Definitely not mill constrained, like most underground mines, it's mine constrained, but there is the capacity, given they can go up to 1.5 million tonnes per annum. If they can do anything over the next few years to try and make that work a bit better, that's a bit more your area, Maddie, but there is potential for them to push through more ounces and get a bit more upside on that front too. So there are all those other little goals that they can sort of strike out for.
Yeah, no, and when I probably comparing it to Spartan mightn't be the right thing in terms of Spartan's probably going to be a lot shallower, simpler, because it's not
28 years
not
old.
as deep, not as hot. There's obviously the North American aspect to it, trying to keep the costs down and keep the delivery of those ounces. But if they can, when you got the grade and your recovery on your side like that, yeah. And I suppose, looking, as you said, they paid a bit more than Telfer and all that, but I think when we did the Telfer Havieron deal, we're like, fuck, that's actually, for what they're getting, is a pretty good deal.
Totally, yeah. I mean, this is...
Mate, you can get a good deal off Newmont. They're flying out the door.
And it's usually a good strategy to acquire assets that come out of majors, right?
Yeah,
like that's
Northern Star. Look at what built them.
Totally, yeah. There's there are exceptions to the rule, but in general, it's a pretty good rule. And I also heard that kind of compared to Evolution buying Red Lake, you've got a much more de-risked and simple miner here, and also a place where the unions are less entrenched than you have in the sort of Red Lake area too.
Do you know who else was on the CA?
Oh, who else had been in the process? Like signed a CA?
Confidential, mate.
I don't know. Yeah,
That's
CAs.
why it's a CA. That's boring.
There was
Why can't you be like Magnetic and tell you everyone who's in the data room? Bloody
They
hell.
had more people up there, mate.
Yeah.
That had a bit of a cheeky slide on value accretion.
They
here.
did.
It's a bit of a funny one given the financing.
Yeah, complimenting them on Buddy. Maybe picking up an asset out of a major, and
It's not all
wishing them
positive.
good luck. But I got to grill them on this slide. Not a fan of this slide, showing how accretive the deal is on a per share basis. You fund your deal with debt. Everything's accretive on a per share basis because you got extra earnings, extra production, extra everything without issuing a new share. Of course, it's accretive. You debt funded it. Duh. So I just
should slide in next to that, like your net debt to EBITDA or something like that, just to show that it's not all one way.
Exactly. Good M&A isn't about per share accretion. It's about sound, weighing up the risk versus reward, capital allocating accordingly for where you have good risk for the good reward for the risk you're taking. I think this slide does nothing to appreciate the additional business risk that it comes with adding leverage to your cap structure. It's just pointing a rosy picture, but you expect nothing else from bankers, mate. They will always post the rosy thing. But I think we're keen to see how it all comes along. I think it'll be an interesting one to follow. Nonetheless, the street liked the deal, and the stock was up like 9% or something.
Yeah, something like that.
So,
What do they trade on again? Orla?
Market.
Yeah.
I think NYSE as well as in Canada.
Yeah.
Bloody
So,
interesting.
Let's talk a bit
Good
about
digging, boys.
metallurgy.
Oh, that's fucking mate. Spartan chucked out some Met results.
Ding to start.
Oh yeah, true. So further, it's sort of most of it was from the top 450 meters. So bring up the pitches and everything. Averaged 92.3% recovery for the over 15 tests for the top 450. So 91.6% predicted recovery based on the grade of those regions and the predicted plant conditions. So they gave like the Met test results and then I guess the predicted recovery based on the way I interpret it, the average grade of those areas and how the plant will operate. So which the predicted recoveries were lower than the test recoveries. So that's a passes the sniff test, you'd say.
Yeah.
So gravity recovery sitting at around 25 to 30%. You can see from the stages and the recoveries for each of those stages, the recovery did decline as they went deeper so stage 4 recovery dropped slightly below 90%. But I'll go into that later. These results were based on, I guess, stage 1 and 2 were 48-hour leach at 100 micron grind, and stage 3 and 4 were 48-hour leach with a 75 micron grind. So we'll get into grind as well because we're going below 75. Now, remember, Dalgaranga has an existing it's got existing infrastructure, 2.5 million tonne per annum mill, so which is run by the big jaw crusher and a big sag mill.
Yep.
So they're going to have to do some mods to that, which we'll get into what we think that might be.
Yep.
Look, the fact I'm going into these Met results in such detail, Spartan, you can repay me by calling Steve Tarr from CRE Insurance and getting CRE to just make sure that existing infrastructure there right now is insured properly, because I'm basing a lot of what I'm about to say is based on that existing infrastructure that is in place. Now, if something happens to it from either acts of Mother Nature or human nature, and they're not bloody properly insured for it, and they didn't take action with CRE, I'm going to be pissed off because all my assumptions are for nothing. I want that mill protected.
It's a layup, Matty.
Yeah, I want CRE to protect it. So, mate, they don't piss me off. Call CRE Insurance.
You've
please.
made it easy for him. I've got maybe off air a story for you involving insurance and Gascoigne. Not Spartan, but the previous. Yeah, I'll tell you that one off air. But
Right.
CRE could have fixed that.
CRE can fix anything. Gascoigne would still be going probably if CRE were involved.
I could make a case that would be possible.
But are you taking into account how good Steve Tarr is when you make that case? Anyway, no. The positive thing for potential recovery improvements based on these Met results, and I'll bring up the graph here, is this. You can see there's a linear relationship between the grind size and the 48-hour tails grade for the preliminary results they got for stage 5 and 6, which is the deeper stuff, the honeypot of Never Never. So, yeah, so the overall recovery, and you can do it from the tables. You subtract that tail grade from the head grade and divide all that by the head grade. That gives you the overall recovery. Essentially, what's getting pissed, the shit they get compared to what's getting pissed out to tails. So you can see for stage 4, so 7.2 minus 0.74 divided by 7.2 gives 89.8%. So that was done at 75 micron grind size. Now you can see on this graph, based on these two preliminary tests on the deep stuff, the tail grade keeps decreasing as they grind it finer. So at 63 micron, which is, we don't usually talk about 60. Usually it goes 75, and then they start talking about like high pressure grinding rolls and things like that. But
I remember Stuart saying 75 was a bit of a...
Yeah, it's usually, I think it's the rule of thumb where you sort of what you go down to. But at 63 micron, the average recoveries were 92.2 and 92.5%. So they've, added. It looks like if they do grind it finer, they can get another couple of percent recovery. So, extra 2% recovery over 150,000 ounces. There's 3,000 ounces.
Yeah. More power, though.
There is more power. It does require more power. But it's after that power is consumed, like,
what's the benefit?
Pouring an extra gold bar fucking doesn't cost anything more if you're pissing it out the tails. So it's a cost, it's a power to bloody revenue comparison that they'll need to make, because
marginally more grind media as well, hey?
Yeah, so you would need it's a power thing, but it's a capex thing, because to grind it down to 63, they're talking about doing test work to grind it down to 53. So if they can increase the recovery even more, so they effectively need a bigger ball mill. So you need a bigger ball mill which has more balls in it. And because it's bigger, it requires more power. So it's all going to be based. Mate. It's all going to be based off a kilowatt calculation at the start. It's like, right, are we going to grind to 63 or are we going to grind to 53? How big of a ball mill do we need to install? With I think ball mills run at, I think it's 30 to 35% ball charge. But if you've got a bigger ball mill, there's more balls bloody in it to bloody grind the absolute living piss out of it. So now, considering what they've got already, I know I've talked about it before, is so that ball mill has to go in. They need that ball mill to grind it down to 53 or 63. That's a given. But considering they've got the massive jaw crusher and the massive sag mill already, they've obviously got the two options to either so they can go jaw to the big sag, then into the ball mill. From that, there's scats that come out of the sag mill that have to be either chucked back into the sag mill, or you need like a tertiary cone crusher, I think it is, like to actually crush those scats down to then feed back into the SAG. Otherwise, you just got these fucking shot puts everywhere that are good for fuck all. Or they can install a 3-stage crushing system to go into the ball mill. So the existing jaw, then 2 cone crushers, gyratory like cone crushers, that'll get it down to your 8 to 10 mil that is needed to then feed into the ball mill. So it'll be weighing up right, because I'm pretty sure the big SAG mill they got would use a lot of power. So it's like, but it's there, it's already there. So it's like, well, is that the best option, or is installing 2 cone crushers and having the 3-stage crushing system to go in the better option? Two cone crushers versus 1 SAG mill. You got 2 bits of kit to maintain rather than 1. So it's going to be that's going to be the way up. It's like you would. I think I said it the opposite way in previous episode, but you'd think if they can go jaw to existing SAG, manage the scats into a new ball mill, considering that existing infrastructure, I think that's probably the way they'd go. So I think 3-stage crushing into ball was the norm, but I think places like, from what I've heard, Thunderbox, Mungari, they're going jaw to SAG to ball. So
Interesting.
Yeah. So considering it's already there, Spartan or whoever the fuck are going to mine this, whoever's going to own it, they'll make that decision in due course. Could have, God, if they raised $300 when they were up at $1.50. That would have bloody helped them. They could have had all the money for it then. Back at $1.20, up 10% today. They went back to $1.10.
Yeah.
I mean, gold price ripped up. So
Yeah. The more cash you raise, the less likely you are to get acquired too.
But yeah, maybe.
Yeah.
Depends if someone wants cash.
Yeah. Most of the miners are cashed up, aren't they?
I think you just got a deal in the
They
present.
They shouldn't even be thinking about getting acquired. They should be thinking about mining it. Go mine it. Right. Sayona Piedmont set to tie the knot. Is it a bit of a what were those? Well, the 2 AVL, was it Australian Vanadium and TMT? Yeah, logical merger.
Yeah.
There's one we were expecting, that's for sure.
Totally. Yeah. I'm impressed by your metallurgy knowledge. It just gets better and better every
Thank
time.
you, Travis. Nathan stored us as like a proud father.
Yeah, this is so Sayona Piedmont. They're tying the knot, and the details of the deal kind of emerged about 30 minutes before we hit record. So we got to see what it all looked like. So the deal is basically both companies are going to emerge with 50% each of the merge co, which is technically the head co is Sayona, but like they're calling it merge co, which means they're going to rename the company, I reckon. And it will be run by Sayona's CEO at the moment. All up, there's $150 million of new equity in Australian dollars that is going to make its way into that pro forma entity in a somewhat kind of complicated manner. Sayona's launching they launched a $40 million capital raise kind of today. Piedmont is expected to do similar sort of when the markets in the US open, and then once the merger is effective with about 40 million Australian each in their respective things, the 2 companies are going to merge, and at that point, RCF has this conditional placement where they're going to tip in about 69 million Australian as a conditional on that
into the pro forma.
Into the pro forma.
Have you ever seen anything like this?
Then another capital raise for another 22.5
exactly.
million.
And a potential follow-on raising for another 22.5 to come.
Where
after that too.
Have you ever seen that where both sides of a merger are both raising money?
Oh no!
To make a merger happen,
I haven't seen both sides doing it. But I have seen the conditional raises do happen a bit, especially with private equity. You'll see Aussie Super do it from time to time in mining companies, things like that. But
whatever the North American equivalent of 6011 is, Cottesloe, the brokers would be so happy over there. What is the 6011 equivalent in Canada?
Don't know.
There'd be something in Vancouver there.
Love it.
Yeah, so you got all this new equity coming into it, and there's some obvious benefits here, not least of which is just the simplification of the North American lithium ownership dynamic. 100% owned by the same entity. You don't have that weird offtake in place, which was just a big drag on the complexity and the way that investors sort of had any appetite for either of the companies. Really was just quite onerous offtake depending on what the lithium price was at any point in time. This deal just tidies all of that up. So it just makes sense. It's overdue. What do you guys think of that component?
Yeah, I mean, just to add a couple more points, Maddie, you mentioned Canada, but it's a bit funky, very North American focused. Headquarters going to be Brizzy.
Which
They're
is
going to have
Sayona's
the primary
HQ at the moment.
Yeah, primary listing will be ASX. That makes sense from a capital markets perspective, with a secondary listing on the NASDAQ. So not actually
The NASDAQ.
Yeah, well, that's where
Piedmont's
Piedmont
head
has
listing
a listing. So not actually Canadian listed, but obviously
On
a very
the tech fucking on the
tech exchange.
index.
Well, there's a punting exchange. Lithium has a sort of avenue into EVs.
There you
Get
go.
creative.
Yeah.
I mean,
I
I
think thinking.
That sort of came about from a sort of Carolina. They've got an asset in the States there as well. So, and then there's that Ewoya interest as well that they chat about in Africa.
The pro forma looks kind of more interesting with the you've got the other, like Carolina got its approvals recently. You've got the Ghanaian asset, which is, again, there's been some momentum there, and you've tied it up now. So the pro forma actually kind of looks interesting-ish. Importantly, though, there's going to be a bunch of kind of cash in there, which buys them time, right? In a depressed lithium market, that buys them more time, and also importantly, introduces RCF as like a kind of 10% shareholder of the pro forma who is writing a big check, but also has the ability to write another big check if they need to buy more time in the future as well. That's important.
What do you take of their role in this? Their involvement, RCF.
Super interesting. Honestly, I find it really interesting. I mean, like, one of the really big wins RCF has had in recent history was when Altura was distressed and Pilbara Minerals kind of snavelled it up right before the lithium market turned. It was like a month before lithium market turned, and RCF kind of cornerstoned, big equity kind of cornerstone position there to help facilitate the acquisition of Altura. So everyone really remembers, and in like no time, it was like a 3 times money on money in like 10 months from memory. It was just a huge win for RCF, and so everyone remembers that in their head. Big win for RCF. That was like counter-cyclical, depressed lithium market, big consolidation kind of equity play for them. This looks similar-ish. Lithium market's beaten up. There's 2 logical companies kind of coming together, helps them sort of buy more time. Hopefully the cycle picks up and makes the equity kind of look, attractive over time. No one can really time when the market turns perfectly, but I'm sure everyone who's been a part of that deal is sort of thinking, I hope this is like the Pilbara gobbling up Altura sort of play.
Yeah, and it's whoever can survive. If there is a turn, it's like you start getting paid for it straight away.
And specifically on North American Lithium, the asset, it was hindered by the structure it was in with the economics there and the sort of skewed offtake and ownership. So hopefully this will clear that all up, and they can just focus on getting those recoveries up, getting the asset.
They're still going to be losing free cash flow on it at the current lithium prices, but they've got greater capability to last longer in the cycle now.
What's happening with Mublin?
Development asset. I mean,
on ice. Pardon the pun.
Definitely is. Yeah, permitting will be the challenge. I mean, financing won't be a walk in the park in this market either, but permitting's been the big impediment.
Yeah. It's actually an attractive asset, but permitting's the big challenge there.
Grade is much better than North American Lithium, although one's in production, one's not, obviously.
Yeah.
So, I mean, they just need to get costs down at North American Lithium to in the ballpark of the DFS that came out in, I think, April 2023, because right now they're nowhere near that. And also get the revenue up. There's been a period of sort of qualifying the product and all those things. So just to make it, go from a cash bleeding asset to something that's closer to break even, that'd be first item on the shopping list.
Very good.
That's it, Matthew.
That's a wrap.
It's funny that what did you say yesterday, Trav? Oh, I'm so not interested in lithium anymore.
Oh, the market. Yeah.
The future and we've got a lithium deal.
We'll see what comes of it. It's a better time to do a deal than it was a year ago. So, I mean, more particularly if you're RCF. But
Oh, mate, I reckon I know who was behind that. Someone that moved over to North America recently.
Interesting. We'll share that one off air.
He's a GC.
He is.
GC.
He is indeed.
If you're listening and you know who I'm talking about, you're a GC, Mr. Person. Gee, speaking of GCs, Mineral Mining Services, absolutely jam-packed. Every bloody truck and digger is full of a GC, MMS, but grounded, heading to Canada. CrossBoundary.
GC's in the name, grounded construction.
Yeah. Have we mentioned that yet?
I don't know.
Grounded construction.
There you go.
CrossBoundary Energy, Sandvik Ground Support, CRA Insurance, K-Drill, DashSat, and Hootaroo Money Mines.
Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.